Real estate and high risk investments. Real estate means consisting of land and/or buildings. High risk investments that carries a high degree of risk, meaning there is a strong chance that you could lose a substantial amount or all for your investment. In case of penny stock and easily lost most of all your investment. Here are the some of the high-risk investments: crowdfunding, crypto assets, foreign exchange, hedge funds, inverse and leverage ETFs, private company investments, and real estate-based securities. Making money in real estate. Income and capital gains. When we say capital gains, it is generally included in taxable income, but most in causes are taxed at a lower rate. Income, current income, its sources include dividends and interest payments. Dividends are periodic cash payments paid to shareholders by companies. Next is the current income results from passive cash flow. Passive cash flow means that you have more money going into your business at any given time that you do coming. The price appreciation leads to capital gains. Gains are not the income you earned as an employee or from your own business, but rather are due to the increase in value of your investment. Capital gains are taxed differently than regular income. Though leverage can increase an investor's return, there is a positive and negative leverage. Positive leverage, cash and cash, is greater with loan without cap rate less interest. Loan constant less cap rate is equal to positive leverage. In negative leverage, when a company purchases an investment using borrowed funds and the money has a greater cost or higher interest rate than the return made in the investment. The last one is the beneficial and tax treatments. The capital gain treatment, avoidance of dry income, and the availability of favorable tax regime for a specific LTI. Next would What are video capital clip gains? About
Capital gains are profit made on an investment when that investment is finally sold. Capital gains may be realized in the very short term, after hours or days of holding an investment, or in the long term, decades after the original investment was made. Capital gains are not the income you earn as an employee or from your own business, but rather are due to the increase in value of your investment. For this reason, capital gains are taxed differently than regular income. How do you calculate capital gains? Capital gains are calculated by subtracting the basis, your original investment, from the final sale price. For example, if you purchased an investment property for $100,000, the basis, and later sold it for $600,000, the sale price, your capital gain would be $500,000. Short-term versus long-term capital gains. Short-term capital gains are any capital gains made from an investment which was held for less than 1 year. For example, if you purchased it, held it for 9 months, and then sold it for a profit, your profit would be considered a short-term capital gain. Short-term capital gains are generally taxed at a higher rate than long-term capital gains. Long-term capital gains are those derived from an investment held for more than 1 year. If you had held the same stock for 2 years before selling it, your profit would be considered a long-term capital gain, which is normally taxed at a lower rate. Do long-term capital gains count as income? Long-term capital gains are considered unearned income by the IRS. Earned income is different from earned income, which is money you have earned through your employment. Unearned income is profit derived from interest, dividends, capital gains, and other forms of income not directly related to your paycheck. Capital losses. Capital losses occur when the value of an investment is less than the original purchase price and are realized when the investment is sold. Investors may offset taxes owed on capital gains by factoring in their capital losses. Net losses of $3,000 or more may also be carried over to the following year, further reducing the investor's tax burden.
Overall, investing is how you take charge of your financial security. It allows you to grow your wealth but also generate an additional income stream if needed ahead of retirement. Various investments such as stocks, ETFs, bonds, or real estate will provide either growth or income, but in some cases